Good morning. This is Arlan Suderman, Chief Commodities Economist at StoneX. It's a little after 8:30 a.m. Central Time as we open up the commodity markets, and we see the movement this morning once again as we head into the weekend. Um, I think a couple of things of note are interested. First of all, we're seeing this if I can go higher, if I can go high, you can go higher type of a bidding war on the tariffs between the United States and China. China's up to 125%, US up to 145% on China now. It really doesn't matter. Whatever the number is, trade has essentially been shut down. So for the US consumer, that means they are unable to get the consumer goods that they want unless they're willing to pay more from an alternative source. And I do anticipate, in many cases, those alternative sources to open up and start becoming available, albeit, as I said, at a higher price. For China, though, it means loss of a $430 billion annual consumer market, and that is a big hit on it. Its currency did stabilize against the dollar because the dollar fell sharply to three-year lows this morning. And we'll talk a little bit more about that. But the problem for China is that its currency has fallen notably versus its trading partners, its other trading partners. That creates some challenges for it. Now, that does help stimulate demand from those other trading partners to try to offset some of the $430 billion U.S. consumer market that it's losing, but it can never replace the U.S. consumer market. It's going to have to stimulate more. We look for some bank reserve ratio requirement reductions. We look for some interest rate reductions, those things in the days and weeks ahead, and possible some other actions regarding its currency. It also has to worry about capital outflows out of China that could create some problems for it overall. So the challenges continue to increase. Now, here in the United States, a weaker dollar and the higher treasury yields suggest that we're seeing a big drop in buyers for those debt certificates. Supply of debt certificates is high, demand is dropping, pushing treasury yields higher. Is that foreign investors moving their money home? Yeah, I think part of that is the case. Also, some basis trade unwinds happening as well. Maybe some other factors at play as well. Some hedging strategies that are being involved here. But the bottom line is we are seeing those treasury yields going higher at a time when President Trump wants lower interest rates. And I think that's going to be a difficult objective for him to achieve. I wouldn't even be surprised at some point down the road if we see the Federal Reserve going back to quantitative easing to try to absorb some of those debt certificates and ease the upward movement of those treasury yields. Of course, if we go into inflationary time, it would want those higher treasury yields to stop inflation. But right now, you look at the consumer price index data that came out yesterday and producer price index data that came out today, and it would suggest that we have a bigger deflation problem in the near term as consumers are pulling back from the purchase of goods and services both. And that's a concern to the market. We saw that play out to a great extent yesterday. To some extent, we're seeing it play out today. But over in the commodities, again, energy prices still trading basically fears of increased supply from OPEC at a time when we're seeing demand for energy drop because of a possible recession domestically and globally. But when we look at the grain and oilseeds, we're seeing some rotation of money into that sector and also some end user buying coming in and saying, at these prices, maybe there's more upside risk. We did see USDA increase exports of corn yesterday by 100 million, partially offset by 25 million bushel decrease in feed usage. But they could go up another 100 million in future months. It all depends on how this export program continues to play out. Now, that doesn't necessarily mean we're going to run out of corn this year, but it does suggest that the margin for error is much lower now for potential weather problems in Brazil ahead of their pollination over the next several weeks of their big crop, and amid some of the weather forecasters calling for potential problems with the U.S. crop, particularly west of the Mississippi, this year, where more and more of our crop is being grown west of the Mississippi over the last 10 to 15 years. And then also something that I thought was very significant in yesterday's report, even though it's one of the smallest changes USDA made, it was very significant. And that was the 10 million bushel increase to soybean crush. Frankly, with what's happening with the slowdown in biomass diesel production right now, crush has been decreasing. And so the USDA should have been decreasing crush, but the fact that they went up at all rather than go down, even though it was just 10 million bushels, suggests that USDA may know something about what EPA is about to do. We know that EPA was given an industry recommendation to raise the biomass diesel production mandate to 5.25 billion gallons, up from 3.35 billion today. That would be huge. Now, we at StoneX believe it'll be more likely be around 4.25 billion, maybe 4.5 billion, but either way, that's still a big increase. And so apparently, it looks like anyway, USDA must be aware that EPA is about to do that, and relatively soon. By relatively soon, I mean in the weeks ahead. I don't mean 3-4 months from now, in the weeks ahead, to push this, to reverse the trend of lower crush in order to support a higher number. And psychologically, that gives a big boost to the soybean market, particularly at a time when the market's starting to sense fear over these Chinese tariffs are driving farmers away from planting soybeans, maybe even less than what USDA reported on March 31. So generally seeing some support, not we saw an initial surge when the grain and oilseed markets opened up, but then it backed off a little bit. We're going into a weekend here when the headlines continue to flow. European negotiators are expected to be in Washington, D.C. to negotiate lower tariffs this weekend. We're also going to see other countries that are negotiating that we've heard about as well. President Trump needs to have some wins on the negotiation. He needs to have some reassurance to the markets. Now that with the pause, he is making some progress on that. So we may see a little bit of care going into the weekend, but overall, that's an assessment on this Friday.